Whether you're just getting started with investing or already have money in the market, chances are you've heard these terms: index funds, mutual funds, ETFs, and hedge funds, thrown around on podcasts or finance TikToks. They all sound like smart ways to invest, right? But what do they actually mean? How do they work behind the scenes? And more importantly, which ones can really work for you and which ones can quietly drain your returns with hidden fees and risk? The reality is that every time you try to invest, you hesitate because you think you're already too late. You want to do it right, but without real guidance, you're scared of ending up making dumb mistakes. And every time, that fear of not knowing holds you back. Don't worry, because in this video, I'll break down how each of these funds operate, who they're really built for, what their returns and risks look like, and how to make smart and confident choices based on your financial goals. By the end of this video, you'll not only understand the difference between these funds, but you'll also be able to spot the red flags, dodge the marketing hype, and invest like someone who actually gets it. Let's begin. Section 1. What are funds? Funds are like a giant community pot where a bunch of people throw in their money to buy something together. Imagine you and a group of friends all want to start a small business, but none of you have enough money to do it alone. Instead of each of you trying to open a separate tiny shop, you decide to pool all your money into one big fund. This fund then becomes your collective capital to invest in a larger, more viable business, maybe a popular cafe or a well-stocked bookstore. This pooling concept of money solves three major problems for you. 1. You get to invest in a variety of assets, something very expensive to do alone. 2. Experts manage your money and do the research for you. 3. Costs go down because many people are investing together. That's how the funds do the heavy lifting. They spread your money across different investments and divide the risk among the investors with the hope of growing the cash over time. Now let's first look at index funds. Section 2. What are index funds? Imagine there's a big basket of stocks representing the whole market or a specific part of it. This basket is called an index. For example, the S&P 500 is an index that tracks the performance of 500 of the largest US companies. Now, an index fund is like a special type of investment fund that simply tries to copy that basket exactly. It buys all the stocks or a good representation of them in the same proportions as they are in the index. Index funds are really simple and effective. For example, if Apple makes up 7% of the S&P 500, then 7% of the index fund's assets go toward Apple stock. This type of fund doesn't try to outsmart the market. They are the market. When you invest in S&P 500 index fund, you're buying a tiny piece of the top 500 companies in the US that include Apple, Amazon, Microsoft, Tesla, and many other heavy hitters. By doing this, you stopped stressing over which stock to pick. So, you are simply just riding the wave of the entire market by saying, I don't need to pick the winner, I'll just bet on the whole race. And the best part about the index funds is that they are dirt cheap. Like most of them charge less than 0.1% in fees annually. That means for every $1,000 you invest, you pay less than $1 in fees per year. Even the investing legends like Warren Buffett swear by index funds, because the average annual return of the S&P 500 over the last 30 years is around 10%. Index funds have ridden that wave right alongside it. So, basically, you can consider investing your savings in index funds anytime you want, as they swear by long-term growth without having to babysit your portfolio. These are perfect for retirement savings, college funds, or just building wealth over time. Whether you're just starting out or you've been investing for years, index funds are a solid, low-cost, low-drama option for you. Some of the most popular index funds in 2025 include Vanguard S&P 500 ETF, Schwab S&P 500 Index Fund, and Fidelity 500 Index Fund. Now let's learn about mutual funds. Section 3. What are mutual funds? Mutual funds are the type of funds that are managed by an expert. Imagine you and a bunch of friends are planning a fantastic but very expensive dinner party. You all love food, but you don't have the time, expertise, or sheer amount of cash to buy all the ingredients, cook all the dishes, and set everything up perfectly. So, you decide to hire a master chef to do everything for you. That master chef is like a mutual fund manager handling it all. You hand over your money to a fund manager who handpicks stocks, bonds, or both, trying to beat the market with a management fee, typically 0.5% to 1.5% annually. And if they don't beat the market, you still have to pay them. It's like paying a chef who promises to make the best meal ever, but sometimes just serves you a regular sandwich. It's also like ordering a curated meal instead of hitting up a buffet because someone else is making the choices for you. In mutual funds, you buy shares in the fund, and the fund's value gets calculated at the end of each trading day. Surprisingly, the mutual fund industry manages about $27 trillion globally, with roughly $25 trillion of that in the United States alone. Despite the rise of passive investing, many mutual funds continue to attract investors seeking specific strategies, geographic exposure, or the potential to outperform market averages. Let's look at a real example: the Fidelity Contra Fund, which is one of the largest actively managed mutual funds, has delivered an average annual return of about 13% over the past 25 years, compared to the S&P 500's 10.5%. However, it charges an expense ratio of 0.85%, and its performance has been more volatile, with some years significantly underperforming the market. So, they're a solid option for people who want professional guidance, but don't want to pick individual stocks. They're especially common in employer-sponsored retirement plans, where mutual funds are often your only option. Just watch the fee, as they can eat into your returns over time. In 2025, some well-known and popular mutual funds in the US include Vanguard's 500 Index Fund, Fidelity's Zero Large Cap Index, and Fidelity's 500 Index Fund. Moving on to the next type of fund. Section 4. What are ETFs? Exchange-traded funds are like index funds but with superpowers. If index funds are your chill, long-term friend, ETFs are their cool cousin who's always ready for action. He saw the market dipping at 11 a.m. on a Wednesday, so he just sold the stocks, then noticed a great opportunity at 2 p.m., so he bought the stocks. In this way, he provides flexibility, which is something you don't get with traditional mutual funds, which only trade once at the end of each day. You can buy and sell them like individual stocks anytime during market hours. Even the numbers are impressive as of early 2025. There are more than 3,400 ETFs in the US, managing over $8.2 trillion in assets. The largest ETF is SPY, which tracks the S&P 500 and has over $500 billion in assets. That's bigger than the entire economy of some countries. Another popular ETF is NASDAQ 100. So, if you appreciate the diversification of mutual funds but want the trading flexibility of individual stocks, ETFs are your jam. Let's say you want to invest in technology companies. Instead of researching and buying shares in Apple, Microsoft, Google, and dozens of other tech stocks individually, you can buy one tech ETF that holds all of them. One purchase, instant diversification. So basically, they're perfect for investors who want low-cost exposure to broad markets, but also like flexibility. Let's move on to the next section. Section 5. What are hedge funds? Let's talk about hedge funds. You've probably heard the term tossed around in finance news or movies, usually in the context of billionaires and high-stakes trading. Hedge funds are private investment funds designed for the ultra-wealthy. To even get in, you typically need to be an accredited investor, which means having over $1 million in net worth or a very high income. What makes hedge funds different is how flexible and aggressive they can be. They can invest in just about anything: stocks, bonds, real estate, currencies, even bet against the market or borrow money to amplify returns. They're not trying to match the market. They're trying to beat it, often with complex strategies. But here's the catch. They charge very high fees, often 2% just to manage your money and 20% of any profits. And despite that, most hedge funds haven't actually outperformed basic index funds in recent years. Studies show that the average hedge fund has underperformed the S&P 500 over the past decade, after accounting for fees. The HFRI Fund Weighted Composite Index returned about 7.1% annually over the past 10 years, while the S&P 500 returned over 13% annually. Yet hedge funds continue to manage about $4.5 trillion globally because they serve a specific purpose for ultra-wealthy investors. During the 2008 financial crisis, while the S&P 500 fell 37%, the average hedge fund fell only 19%. For investors with $50 million portfolios, that difference represents millions of dollars in preservation of capital. Some of the increasingly popular hedge funds are Citadel, Renaissance Technologies, D.E. Shaw, BlackRock, and Elliott management. So if you're just starting out or building long-term wealth, you don't need hedge funds for now, and that's a good thing. Stick to index funds and ETFs, and you're already ahead of most people. Section 6. Best investment options for beginners. If you're new to investing, just don't hesitate and get a start with index funds or ETFs because they're low-cost, beginner-friendly, and backed by decades of solid performance data. Understand that learning about funds isn't just academic knowledge, it's the foundation for building wealth over time. Whether you choose index funds, mutual funds, ETFs, or eventually graduate to more sophisticated strategies, the most important step is to start investing regularly and consistently. Time in the market beats timing the market, and the power of compound returns works best when you give it decades to work its magic. So from this we can say that in investing, boring often wins. The funds that promise the most excitement often deliver the most disappointment, while the funds that simply track market performance consistently deliver solid results for patient investors. Even the data consistently shows that for most investors, low-cost index funds and ETFs provide the best combination of diversification, performance, and cost efficiency. They're not exciting, they won't make you rich overnight, and they won't give you bragging rights at dinner parties. But they will steadily, reliably help you build wealth over time. Don't let analysis paralysis prevent you from starting the journey to financial independence that doesn't require sophisticated strategies or perfect timing. All they require is consistency, patience, and understanding of the powerful tools at your disposal. Now you have that understanding, so no more excuses for staying on the sidelines, because now you've got the roadmap to get it all started. But before that, smash that like button if this has cleared up your confusion. Drop your questions in the comments. Hit subscribe because I break down finance with utmost clarity. Most importantly, open an investment account this week and make your first investment, even if it's just $50. Thanks for watching. See you in the next video.